Let's go bear hunting with Peter Schiff, President and CEO of Euro Pacific Capital. Peter, good to have you with us.
Good to be in studio.
Does it matter to you that they're coming over to your bearish side? I mean, does it make you worried?
No, because
you're the contrarian?
They're just still little cubs. I mean, they haven't really matured into a full-blown bear yet. They have no idea just how bad it's going to be.
Okay, so how bad is it going to be?
It's going to be awful. But, you know,
he says,
how much worse? Because since we saw you last, we got a jobs report that some people will say was terrible.
Do you guys remember the financial crisis of 2008? Did you think that was bad?
Yes.
Yeah, this is going to be worse. Now, but it's not necessarily going to be concentrated in the stock market. See, I think that the government, the Federal Reserve, their main goal is to make sure that the stock market doesn't collapse again, to make sure that the real estate market doesn't collapse again. And they may succeed, but only by sacrificing the dollar. And so we're going to a currency crisis. And this crisis is going to be much bigger than a financial crisis. The impact it's going to have on the average American, on his standard of living, on his way of life, is going to be much more profound. And sure, people won't lose as much money in their stock portfolio, but if they try to sell their stocks and spend the money, the purchasing power that they lose is going to be much greater than what was lost in 08. And of course, 08 gave way to a huge comeback in 2009. So we got saved. We're not going to have that kind of reprieve again.
Peter, first of all, thanks for coming into our gym. And you make a lot of very important points. I think a lot of them I actually agree with. I mean, we're in a place here where Federal Reserve is, I think there's financial oppression going on. I think a lot of people are truly suffering. But the problem is, how do you play that? And to me, all I've heard from you for the last 5 years or 6 years is that the market's going to hell in a handbasket and that the dollar is going to hell and that treasuries are going to 6 or 7% yields. And in fact, really almost the opposite has happened. So, I'm curious, one, how you're positioned now and ultimately what you've been doing over the last couple of years to counter treasury yields that have fallen a couple hundred basis points. A dollar that's really, it's my, as we say, our dollar, your problem. The dollar does what it wants to do. And the dollar, until proven otherwise, is the global reserve standard.
Yeah, well, first of all, I haven't been saying stay out of the stock market. I've been saying stay out of the dollar. I've been saying buy foreign stocks. And that trade worked until about 2014. That's when the dollar started to rally. And the dollar only started to rally because everybody believed that the Fed's program actually worked, that we had a real sustainable recovery. The Fed could actually normalize policy, raise interest rates, shrink its balance sheet, and everything was going to be fine. That's why the dollar started to rally. So it's only been a couple of years. But now people are just beginning to realize that that wasn't true, that the policy didn't work. In fact, it not only didn't work, it made everything worse. We've dug ourselves into a deeper hole. People are going to find that out now when the Fed can't raise rates, when they have to go back to zero, and when they have to do QE4. And so I think the dollar is going to implode. Meanwhile, look at the trade, right? You mentioned this Dow hit above 18,000 today. What is it up? 3% on the year. The average gold stock is up 90%. The average silver stock maybe is up twice that much.
Yeah, I mean, but talking about gold stocks in a very, I think, kind of convenient fashion. I mean, the reality is, Barrick, sure, it's up from $6 to $18, but I mean, what were you doing from 53 down to 6? And it's very easy to say, oh, I'm long gold stocks now, and you've been long gold for 3 years.
No, I've been long gold stocks really since 1999, 1998. So it's been a roller coaster ride, and
So you're riding through these positions.
We've had some opportunities to take some profits, and we've been able to add to our positions. But if you look at even the non-gold stocks, I mean, the U.S. markets are standing still. I have just my strategies that don't even include gold stocks are up about 15% this year so far. We're only halfway through the year, and I think by the end of the year, those strategies could be up 50%. So we are making back the paper losses of the last couple of years very quickly. But this trade is just getting started because the dollar is falling and gold is rising when people still expect the Fed to raise rates. Imagine what's going to happen when they expect a cut.
So let me ask you this. So because of what the Fed has done, they've pushed money out into the world. We have $9 trillion of dollar-denominated foreign debt. Foreign companies have taken out this debt in U.S. dollars. If the economy starts to get weak, they're going to have to pay back that debt. Doesn't that support the dollar? And that to me is the bull case for the dollar.
In fact, as the U.S. economy gets weak, the burden of repaying those debts becomes easier and easier because the dollar goes down. That's going to be the problem because once the U.S. economy, once the Fed has to admit that we're in recession, what are they going to do? They're going to cut rates. They're going to start printing up a bunch of money. The dollar's going to tank. Commodity prices are going to rise. And all of a sudden, a lot of the emerging markets are going to be in better shape. A lot of the countries that were hurt by the strong dollar and by the fear of higher Fed rates, all of a sudden those economies are going to take off, and those dollar-denominated debts are going to become easier and easier to service. The problem is going to be in America, because here's what's going to happen to the Fed. Because even though the Fed hiked rates in December, real rates are lower today than they were in December because inflation has increased by more than that quarter-point rate hike. And that's going to continue. So imagine what happens when the Fed starts cutting rates as inflation is getting worse. And then real rates really tank. And then the dollar just drops through the floor.
So, Pete, I've been given the power at this time to make you Fed chair. What's the first thing you do? How do you get us out of this problem that I think, in a lot of ways, I agree 100% with you. But how do we solve it?
Well, we have to do the opposite of what we've been doing all these years.
What would you do?
Well, we have to allow interest rates to rise and find a true market level, which is going to be substantially higher than where it is right now. The Fed has to stop, buying bonds, and it tries to unwind its balance sheet. But in doing that, we're going to prick a lot of bubbles. Stocks are going to crash. Real estate's going to crash. Banks are going to fail. I mean, it's going to be 2008.
Peter, are you writing books right now? Are you trying to make headlines?
No, I'm just trying to answer the question as to what I would do if I was Fed chairman. Because all we're doing now is giving more drugs to a drug addict, and that is not going to solve the drug addict's problem. I want to take away the drugs.
Every other central bank in the world is doing the same thing.
Well, okay, so
and they're following the Fed.
Yeah, but they're all making the same mistake. Just because somebody jumps off a bridge doesn't mean you're going to jump off too. This is the wrong policy.
You're going to fight global central bank policy and say, I think stocks are going down, and I actually think I'm going to sell bonds because it's a Ponzi scheme, to use your term. Ponzi scheme, U.S. Treasury market. Did you say that?
Well, of course it's a Ponzi scheme. But once the Fed lets rates go up, the other central banks are going to do it too. But what's going to happen when rates go up, right, and this bubble economy collapses, and all of a sudden now Americans have to stop consuming. They can't whip out their credit card and buy things that they can't afford.
U.S. government's refinancing debt at the best level it's ever done.
No, when interest rates
dreamed of this.
No, when interest rates go up, they can't refinance. They have to default.
How will interest rates go up if, in fact, you're saying that the world's going to come crashing down, and in fact, they're making this all worthless?
If interest rates go up, the Fed can't refinance because the rates are higher. All this short-term debt matures at a higher rate.
If interest rates go up, the dollar's going to the moon. Your gold trade's going down.
No, it's not going to go up. Because when the U.S. economy is collapsing because the banks are failing and the stock market is going down and there's no bailouts, the dollar's not going to go up. I mean, the only reason the dollar went up in 2008.
What do you buy then? So everyone's going to go out and buy gold?
No.
That's all they're going to do?
You should own gold.
The dollar is a safe haven until every time we've had a global crisis, the dollar has been a safe haven rally.
It's only a safe haven until people realize it's not safe. There's more risk in the dollar.
You're the guy that realizes this.
Well, more people are going to realize it, right? It got a reprieve in 2008. You forget, when the financial crisis hit, the dollar was at an all-time record low, and it would have kept falling had it not been for that crisis. But the next time this happens, the dollar is going to be the crisis because people believe the whole time. The reason the dollar stopped falling is people believe the Fed could actually
raise rates. And they're going to buy renminbi?
No.
I mean, come on.
Well, sure. Why not?
The dollar is still the world's reserve currency.
For now,
you're telling me the worst financial crisis we've ever seen, and I know you're telling me it's going to be that much worse, and you can probably sell a couple more books.
No,
but the
I don't have a new book, right?
Well, that's what we're talking about here. This is not stuff that's investable advice.
No,
it's advice that's been wrong.
It's very investable advice. Look, nobody has made money in U.S. stocks for the last couple of years. In fact,
you kidding me?
Goldman Sachs came out and said
not true.
That flat is the new up. Well, why don't you look at some of my mutual funds and see what they've done this year? So this is investable advice, but again, wait another year or two, and I'll come back on this program then.
If I wait another year or two at your level of recommendation, I'd be out of business.
You'd be able to retire because you wouldn't need any money anymore.
Sorry.
Peter, good to see you. Peter Schiff, Europe Pacific Capital.